Coming up on Market to Market, presidential candidates outline their vision for key sectors of the rural economy. And North Dakota residents struggle to recover from record flooding in Minot. Those stories and market analysis with Naomi Blohm next.
Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success. This is the Friday, November 4 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. The latest assessment of conditions on the U.S. jobs front revealed the ranks of the unemployed declined slightly last month. The Labor Department reported Friday that U.S. employers added a net 80,000 positions to their payrolls in October. 104,000 jobs were added in the private sector, but the gain was tempered by the loss of 24,000 government workers. The national unemployment rate fell 0.1 of a point to 9%. Modest progress, to be sure, but the figure represents the first improvement in U.S. unemployment figures since July and the lowest rate since April. And companies increased orders to U.S. factories by 0.3% in September, marking the third consecutive monthly gain. The U.S. manufacturing sector, of course, has powered much of America's recovery from the Great Recession. And at a Midwest factory this week, a handful of presidential candidates outlined their vision to ensure more products are made in America. 5 of America's top Republican presidential candidates sat down in Iowa this week to discuss their visions for revitalizing a key American business sector. In a Republican forum hosted by the National Association of Manufacturers, each candidate focused heavily on the benefits of domestic energy production, particularly in rural America.
When you look and see what's happened in North Dakota, Terry, when you see what's happened in the Marcellus Shale up in Pennsylvania and places in Texas where they've opened up these new shale plays to get our coal industry back to, this president of the United States, he's at war against the coal industry. So getting Americans to work almost immediately is my goal.
Governor Perry mentioned Marcellus Shale in Pennsylvania. It's the second largest natural gas field in the world. When I was in the United States Senate 6 years ago, natural gas prices were $12. They're $3.60. So when the president says, well, we can't drill our way to lower prices, yes, we can. We just did. And we can do so in oil with respect to ANWR and offshore. We need to create more jobs in this country through energy, and we have lower energy prices.
Here in Iowa, 20% of the electricity comes from wind. Right. Okay, I voted for Gasohol in 1984. I voted when Ronald Reagan signed it, and we did it deliberately. We decided that it was better for money to go to Iowa than to Iran, better for money to go to Saudi Arabia, to South Dakota than to Saudi Arabia.
But many candidates sitting amidst construction and agricultural equipment at the Vermeer Corporation in Pella, Iowa, lobbied against federal incentives and tax credits for renewable energy, largely on the basis of a smaller federal government.
What I would like to do is a re-examination of those credits, because quite frankly, I'd like to pull them back and let these industries be able to be more self-supporting and stand on their own. I want to pull the regulatory burden back, and then I don't think that we'll need the level of subsidies that we have in the past.
That include ethanol?
That includes all energy.
If states want to compete against each other by putting those types of standards, those types of incentives in place, that is a correct and a proper role for the state. But at the federal level, I do not believe that the bureaucrats in Washington, D.C. ought to be picking winners and losers in the energy industry, or for that matter, in any other industry.
I don't think we should create a heart attack for any industry, but we should phase them out over a period of time. I've suggested 5 years for ethanol and some of these other credits. Let's phase them out. Let's get to it. And I'm talking about not just ethanol, but I'm talking about gas, oil. There aren't any tax credits for coal. They just beat the heck out of coal.
One notable exception to the anti-support rhetoric was offered by former House Speaker Newt Gingrich, historically a staunch defender of domestic renewable energy and the wind industry's tax incentives.
If you're going to have a tax credit, frankly, it ought to be for at least 10 years, because you want a long enough time horizon that people make capital investments. When Congress passes 1 year and 2 year tax credits, it is a tremendously inefficient way to subsidize something, because you never get any capital investment and any momentum because you have no planning horizon.
Trade policy also was a strong talking point among Republican candidates and an audience full of manufacturers searching for new and growing markets.
Congressman, America sold almost $300 million worth of corn to China last year, which was a 5-fold increase from the year before. Last year, American manufacturers like Vermeer sold $6 billion of farm equipment worldwide. Vermeer just signed its biggest customer deal ever yesterday, and it's all export. How would you open up more international markets for American manufacturers?
Sounds like we're doing pretty good with China. Well, what you have to do is be more competitive, and we're less competitive to be the world producer because we have too much taxes, too much regulation. But it's also involved with a monetary system. When a country becomes the issuer of the reserve currency of the world, unfortunately, the biggest export is money. So there's a temptation to buy from overseas, increase your current account deficit, and then you go to consumption. That is our disease.
I'd like to look around the country. I'm not normally pro-trial lawyer, but I would like to look around the country and find the toughest, most energetic trial lawyer in America, make them U.S. trade representative. And tell them their job is to go out and kick in doors to the United States every day, and the more doors they kick in, the happier we're going to be.
As Republican candidates continue to barnstorm the early presidential nominating states, only 2 months remain until the first votes are cast in the Iowa caucuses on January 3rd. The Souris River begins and ends in Canada, but as it meanders briefly through parts of North Dakota, its name, by law, is translated into English, making it officially the Mouse River. Last summer, unprecedented flooding in the Mouse River Basin forced more than 10,000 residents of Minot, North Dakota, from their homes. Flood relief will undoubtedly be high on the agenda for state lawmakers next week as they convene a special legislative session. As Paul Yeager reports, the help is desperately needed as Minot struggles to recover from the worst disaster it has ever endured.
Remnants of some of the worst flooding in North Dakota state history are still visible in Minot 5 months after the Mouse River escaped its banks. It's hard to imagine this tiny river that begins in Saskatchewan and dips into North Dakota briefly before returning to Canada could inflict damage on such an enormous scale. Prolonged flooding in June and July destroyed more than 4,000 homes, swept away dozens of businesses, and caused more than $1 billion in damage. 3 of the 4 dams regulating the river's flow are in Canada. Their outflows are restricted to a maximum of 5,000 cubic feet per second. But at the height of last summer's floods, the Lake Darling Dam, 15 miles north of Minot, released more than 30,000 cubic feet per second. Now, officials on both sides of the border are reviewing management plans, and the daunting tasks of cleanup and rebuilding are left as stark reminders of the power of Mother Nature. Evidence of record flooding is scattered along the banks of the river, but it is on the other side of the levees where the flood's wrath is most apparent. Thousands of homes are uninhabitable, and piles of sandbags remain as silent reminders of the epic flood. Jim Olson's home is one of the condemned structures. He spent much of his time since the waters receded repairing houses belonging to his children. This one, belonging to his daughter, was inundated for 30 days by water from a breached levee.
Whoa, baby, that's a heavy one.
Though skilled with a crowbar, Olson's real calling is as a broadcaster. And as news director of Minot's only fully staffed local television station, he helped warn local residents about the looming danger.
Based on current predictions, we will crest 7 feet higher than 1969 and about 5 feet higher than ever recorded going back to the flood of 1881.
Initially given 48 hours to evacuate their homes, residents quickly moved everything they could to higher ground. But as the water rose, the time frame became shorter until just before 1 p.m. on June 22nd, emergency sirens announced mandatory evacuations were in effect 5 hours earlier than predicted.
That was very surreal. I was on the news set with my son, Perry, both of us with houses here in the flood zone, not that we were worried about that. Sirens went off, and we really said nothing for quite a while. And then just hearing it and knowing what it meant for the people was really moving.
KXMC crews documented entire neighborhoods submerged and water up to the roofs of homes where just hours before, National Guard soldiers had gone door to door alerting residents to imminent danger. At the height of the flood, Olson's skeleton crew was on the air for 171 consecutive hours. And in the 5 months since the disaster, KXMC has continued its coverage of Minot's struggle to recover, a struggle Olson knows all too well.
You have two choices. You can either say, I'm going to fix my house up, I'm going to accept this SBA low-interest loan at 2.5% or 3%, and thus I will have both my original mortgage and a new mortgage from the SBA that might total 1.5 to 2 times the value of my house. But I'm going to do it, and I'm now committed to staying here for at least 12 or however many years until the value of the house rises enough to equal the value of the loans. So you're committed to long term. The other choice is to simply walk away from your loan. And if you do that, you're really committed to leaving the area because there is no place to live here with the housing shortage that we have.
Ultimately, some residents opted not to rebuild, but that was never a consideration for the North Dakota State Fair. And in the hours preceding the flood, General Manager Renee Corselan took steps to protect some of the fair's most important structures. Corselan called in help from Fargo to build a 14-foot wall around the State Fair Center and the newly rebuilt grandstand.
This place was just buzzing, but we only had 2 days to do it in. Hard work, no sleep, but it did get done, and the dikes were 14 feet high. The dike around the grandstand, we ended up taking up the racetrack because there was no dirt. We couldn't find dirt, and the traffic was horrendous with trucks, and so we had to dig up the track.
With some of the infrastructure narrowly escaping the floods, the fair itself was a casualty. Since the waters didn't fully recede until the day the fair was originally scheduled to open, Corselan had little choice but to cancel one of North Dakota's premier events.
I have been with this fair for, I think this would have been my 37th fair, and there was a lot of emotions. The assistant manager has been here that long. Many of us have given kind of our whole life has grown up here. And you bet, we fought hard to save this. This is our heart.
While recovering from a flood of this magnitude is one thing, paying for it is another. Headed into a special legislative session next week, State Senator Tony Grinberg acknowledges the issues are complex.
I would imagine that, we'll have requests coming to help repair part of the state fair. And so those things are just a natural discussion. If we start down the path of having our own state FEMA, what does that mean? And so I think at the end of the day, we're going to find a proper balance that between the fundraising that's gone on to help residents, the federal government, and what role is appropriate for the state to assist the rebuilding of Minot, and so that we're not setting up our own agency for future disasters.
One thing that is not a disaster in North Dakota these days is the economy. A thriving agricultural sector and an oil boom in the western part of the state have resulted in a $1 billion state budget surplus, and the unemployment rate is the lowest in the nation. Next week, we'll travel to Williston, where billions of barrels of crude in the Bakken Formation are creating an economic gusher. For Market to Market, I'm Paul Yeager.
Next, the Market to Market report.
Grain prices were mixed this week as the trade pondered the impact of debt, disillusionment, and a healthy dose of drama in the European Union. For the week, December wheat lost about 8 cents, while the nearby corn contract moved fractionally higher. Soybeans slipped below their 20-day moving average this week as the nearby contract lost a nickel. December meal declined more than $2 per ton. In the softs, cotton gave back most of last week's gains as the December contract lost $5.63 per hundredweight. And in the dairy market, November Class 3 milk futures were down 56, while the December contract moved 60 cents lower. Over in livestock, the December cattle contract rallied $5.45. Feeder cattle advanced nearly $1.50, and the December lean hog contract eked out a gain of 18 cents. In the currency markets, fiscal chaos in Greece forced the euro to shed 428 basis points against the dollar. Crude oil gained a little less than $1 per barrel. COMEX gold advanced nearly $9 per ounce. And the Goldman Sachs Commodity Index moved fractionally higher to close at 653.65. Well, here now to lend us her insight on these and other trends is a relative newcomer to Market, Naomi Blohm. Naomi, welcome back. Good to have you back with us. Well, let's talk a little about some of these big things. And one other factor we didn't mention, MF Global. I mean, there's a lot of elevators, a lot of farmers out there that did business with MF Global, you know, unrelated to the Corzine debt bet over in Europe, wondering what to do. How much of an impact is that having on our commodity markets?
The impact for the commodity market is not actually as much as what people might have anticipated. It was a one-day scare, but right now I think the biggest impact from it is that it's bringing just a little bit of uncertainty to trading in general. And the focus on the whole MF Global thing is that the European situation is far from over. The G20 summit today concluded with no results.
Right.
And so Europe, I think, is going to hopefully be able to avoid catastrophe, but the biggest thing is that they're not going to be able to avoid a recession, and that's going to have a global impact.
All right. Well, that's certainly a cause for concern. And of course, the other thing, I guess, that we're talking about when we're talking about a default like Greece, or we're talking about a situation that lingers on like this, and you have these days where that becomes the dominating factor, regardless what the fundamental situation is. And we have some changing fundamentals, and we've got government reports out next week.
Yep, we got a lot of things happening. And I think the biggest thing right now with the European situation, it's not going to go away. And the biggest takeaway from it is how it's going to impact our markets. And here's how. With the European situation not having any growth, we're not going to be able to have growth here in the United States. But the bigger impact is what will happen with China. China needs to have at least 8% growth every year in order to have social and economic stability. And right now, they're forecast for 9.3%, and next year at 9%. If the European situation can't get under control, and the recession and even the debacle should happen, the European market is China's largest export market, and in September it was down 10%. So if that continues to happen where the export market is down, China as an economy is not going to be able to grow the way people are hoping it would, in which case commodities as a whole are not going to be able to rally with the gusto that people are hoping so. And so it's going to have a major effect throughout 2012.
On this upbeat note, let's move forward talking about individual commodities. Let's talk about the wheat market first then. So what's your take on wheat? What are you telling producers?
Right now with wheat, I think we're at a point where we're going to just continue to hold steady here. The winter wheat crop is 90% planted, 70% emerged, and with the recent rains and bits of snow that have come upon it, no immediate threat of extreme danger. So of course we have to watch dormancy as the winter progresses. Now, as far as, of course, the export market, there is tremendous pressure from everything in the Black Sea, and that's not going to go away. So I think wheat, still just a follower. I don't think it's going to fall apart, but it's going to have a struggle to rally.
All right, we're making sales now, or are we holding off for rally, or what's your thought?
Holding off for rally. I think that if the corn price can have a breakout move higher next week after the USDA report, wheat will follow. There's a lot of short positions in the wheat market, and so just on short covering, we'll see a nice bounce, and I think that'll be a selling opportunity.
Oh yeah, that's a really good point. Okay, so let's talk about the corn market. What do you see happening on that front? We're about to wrap up the crop in most of the Corn Belt, and by and large, not the bin buster I think a lot of people had thought we would have, but a decent crop. Where are we going to go from here price-wise?
Price-wise for corn, I think that we're going to see prices continue to hold the $6 area for the bigger picture. And at the most, I think we'll see $7 as the upside. Next week after the USDA report, we'll have our answer. We're sitting right now at $6.50. Right. We'll either be down to $6 by the end of the next week, or we'll be up to $7. I don't think we'll see prices go higher than $7 because of the global situation. And the market wants to wait to see what the La Nina pattern does in the Southern Hemisphere, as well as just the global implications of trade.
There's concern about the La Nina pattern, what it's doing to the upper Midwest at this point. We've got some extreme droughts, some moderate drought areas in western Illinois and southeast Iowa, north central southern Minnesota. Not a huge trade factor yet, but it's starting to be a concern to people.
Absolutely, it's a concern, and I think that a lot of people are really monitoring the moisture situation right now, and it'll absolutely be monitored this winter in terms of snowfall and how that'll play out next spring. I don't think that the market has any reason to rally or fall apart until we see weather as the biggest factor for next year.
And of course, we've got South American weather too. We'll see more corn in South America, do you think?
We've already seen it, absolutely. Brazil is already forecast to have an additional 9 million tons of corn planted, and so that's already being priced in. I think with the report next week on Wednesday, the USDA is probably going to reduce our yield here a little bit. The market's already factoring it, but the other implication is that they're going to most likely raise some global production numbers, in which case the global spreadsheets will be balanced and prices won't have any reason to rally substantially unless there is a major weather issue in South America.
Strong demand for cash. I mean, should we be selling corn? I've got a lot of people say, well, I've got these storage bins, but do I really need to use them?
It's a great question, and I think right now the basis is so great for corn. We're seeing tight basis in a lot of places, and that's something that you want to capitalize on. A lot of producers are not wanting to sell until next year for tax reasons, understandably so, but at the same time, there's a lot of people who are going to be selling come the first of the year, and so the basis is going to probably widen out by then. So I would encourage, if you can, get more current with the cash situation.
All right, good point. Let's talk about soybeans. What's your outlook there? We're still going to have to count on China for big purchases, and again, big numbers in South America too. We got to watch their weather.
Right. With the third largest global crop and ending stocks, we're not going to see prices do much of anything. And quite frankly, I think that soybeans are going to probably test this $12 area for a while. If it fails, we'll see prices go down to $11.50. But I don't think it's going to really go ever below $11. If you look at some long-term trend lines, $11 is phenomenal support. And I just don't think that we'll see prices go lower than that because the demand situation is so strong. At the same time, we probably are going to have a hard time seeing prices get over $13. So anytime you see a rally, be selling.
All right, take advantage of it. Let's talk real quick on the cotton market, and it's been kind of a seesaw market here for the last month or so, very sensitive to global developments and concern about China and excess supply and a big crop in China too.
Absolutely. I think that cotton is going to have its day in the sun here, though. Next week with the report, I think the USDA will now acknowledge the situation here in the U.S. and the crop that wasn't there. And then also, I think that the USDA has to adjust for Pakistan and the flooding that they had. So we're going to finally see some fresh, friendly fundamental news come into play that'll give the market a lift. And then like wheat, cotton is extremely oversold right now. And if we can just get the market to push higher on a 23% retracement Fibonacci move, we'll see prices go back up to the mid-125s. So I really think that's possible.
All right, the Fibonacci move. All right, well, let's talk livestock. And I want to talk dairy tonight too. But let's talk fed cattle first. As we look at the fed cattle market, seems like demand's been holding in there. Overseas demand's been holding in there. Tight supplies, we're still not holding back any heifers. Not that that's going to do us any good in 2012 at this point. But what's your outlook for the fed cattle market?
It's still a friendly marketplace. And with the news this week that Japan is going to be relaxing their rules and regulations, we're going to see that market continue to grow. So Japan went from saying only 20-month and younger beef coming in to 30 months and under. That's a huge deal. And so that's actually already factored to increase the market by 25% for exports. And in addition to that, you said it quite well that the cow slaughter numbers and the heifer slaughter numbers, we're not seeing any changes in those. And so at this time, I think there's no herd rebuilding. And it's going to continue to be that way until the market sees what the rainfall is and how the pastures are going to be, along with other feed prices. But right now, it's a really friendly picture.
All right, so fed cattle looks good. Calf market then looks to be strong as well because the supply situation is going to be tight. Yep,
absolutely. The charts look friendly. The fundamentals are friendly. There's, at this time, no reason to suggest otherwise.
But in the cattle business all my life, something will show up.
Right.
I don't know what it'll be, but we'll watch and see. But so far right now, you're pretty optimistic. Do you want to hedge any of this stuff, or you think we're going to look for higher prices on both the fats and on the calves?
I think with the cattle market, I would look at some bear put spreads maybe, just something there for just in case. Probably something that you're not going to use, but with a bear put spread, you're buying it at the money put, selling a lower put, no margin calls, and then at the same time, you've got protection there just in case something should happen.
All right, good point. Okay, hog market, what do you see happening there?
A little bit of a lower price, actually. I think we'll see the market go back and test the low 80 level. There's not much friendly news happening right now for it other than the export market, but seasonally, this is the time of year when supplies are up, and that's weighing on price right now. So I think we'll have to see the washout back down, But overall, 80 will hold, I think, strongly, and we'll see the market rally.
All right, let's talk about dairy, milk prices. We've had a good recovery off the bottoms, maybe some herd expansion there in dairy. What's your outlook for milk price?
I would say for the rest of fourth quarter and into first quarter, we have really good optimistic prices. The reason for the increase this week was because of the cheese market. The cheese market, 10 out of the last 13 years in the month of November, cheese has a tendency to rally, of course, due to holiday demand, and we saw that this time. Once the cheese price was able to push higher, the milk price went along with it. Now, we're not going to probably see much for excitement beyond that just because globally we still have a lot of competition from New Zealand and also Australia in terms of the powder market and as also the cheese market. So that's going to keep prices from rallying, and we're seeing a lot of hedging start up right now because it's just tremendous value at the $18 levels.
All right. I want to talk real quick on crude oil and gold. Crude oil, we're mid-90s right now, in that neighborhood. Your scenario is for a slower global growth outlook. Are energy prices going to soften up?
That's a great question, and here's how OPEC answered that. They thought that even though the growth is going to be slowed, there still is going to be growth because of the emerging nations and the emerging economies and the people there needing more energies. And so I think that we're going to see crude oil probably test the $100 level. But I don't think it's going to be able to climb through there because the world is not ready for that right now. And overall, we'll just see the demand stay strong. OPEC wants to see actual production levels not drop off because they think that over an additional 500,000 barrels are going to be used daily into 2012 is right now the outlook. So most likely see it range bound between $80 and $100.
All right, we've had this risk on, risk off market going. Gold right now seems to be risk off.
Right, everybody is putting their money back into that the gold market because it's traditionally that safe haven. And so when investors are nervous, that market's going to continue to see some price increases.
So you don't think we've seen the highs yet?
I think we'll retest the highs, right? I think
on
we're
gold.
Yep.
All right, so again, fairly optimistic on gold prices, maybe commodities holding together. We'll see what happens to the rest of it. Thanks so much, Naomi Blohm, with us this week. That's going to wrap up this edition of Market to Market. Now, if you'd like more information from Naomi on where these very volatile markets may be headed, visit the Market Plus page at our website. You'll find expanded market analysis, audio podcasts, streaming video of our program, and links to our Twitter feed and our Facebook page. And by the way, all free at the Market to Market website. And of course, join us again next week when we'll explore the economic impact of an oil boom up in North Dakota. Till then, thanks for watching. I'm Mark Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Pioneer Hybrid, working with growers to help put the right product in each field. Pioneer, science with service, delivering success.